Coming up on this edition of Money in Your Pocket, Dr. Patrick Lach from EIU School of Business will be here to talk about first financial steps. We'll answer the questions about when to buy a house, how do I start investing and paying down debt. We'll also learn about one of the biggest financial mistakes that young people can make. Patrick has a lot of good advice coming up next on this edition of Money in Your Pocket.
This program is made possible in part by Credit Union One, proud to support Money in Your Pocket. Credit Union One offers savings and lending options. Additional information on membership available at creditunionone.org. Loans subject to approval. Accounts are insured up to $250,000. By member's choice, this institution is not federally insured.
Welcome to this edition of Money in Your Pocket. I'm your host, Lori Banks, and today a guest who was on last season has joined us. Dr. Patrick Lach from EIU School of Business has returned.
Thanks for having me.
Thanks for coming back. Well, today we're talking about financial first steps, and you've thought about this. I know you talk about this a lot, so let's get right to it. Easy question. What is the first thing that we should do in terms of getting our financial house in order?
Well, like you said, with being a professor here at Eastern Illinois, so many students will come to me, and I often speak to student groups. I'm speaking to a student group later tonight about getting started financially. And there's one of the biggest things I tell people is, number one, get an airtight budget. You mentioned earlier that I was on last season, and one of the things we talked about was wants versus needs. Yes. And for anybody that would like a review, I'd recommend going back to that show. But that's the first thing, is have an airtight budget. Make sure that until you go through all these steps we're about to discuss, make sure that there is nothing in your budget that does not need to be there.
So what about, so let's talk in terms of someone who's just graduated from college. They've got their first job and they're no longer a college student, and they think, oh boy, financial freedom, here I go, I'm going to have lots of money, I can buy whatever I want. What do you recommend is their first thing that they should do?
I'll often tell people when they finish college, especially somebody that's completed an advanced degree like law school or medical school, I always tell them step one is pretend you are still a student. Keep spending like you were as a student. One of probably the most common mistake that I see people make is, a 22-year-old finishes with his or her bachelor's degree, and the very first thing they say is, by golly, I deserve a brand new, $30,000, $35,000 car. And they'll look at the payments, and of course the payments fit their current budget, and they think, okay, well, I could afford this car, or I could at least afford the payments, and so they'll buy the car. Or even worse, they go and lease a brand new car. And the problem with things like that is it puts you in such a hole that it becomes more difficult to go through the steps that we're going to discuss here in a few minutes.
All right, so what about having a reserve? How much money do you recommend people have in reserve?
It depends. Starting out, I think you want to have 1 month of expenses extra. So, in other words, if you spend, say, $2,500 per month, at the start of the month, you should have $2,500 for your current month's purchases and then $2,500 as a backup. So to start the month, you should have $5,000 in your checking account. Okay. And that's one of the most common mistakes that I see people make. In addition to being a professor at Eastern Illinois, I'm also an investment advisor with Lach Financial. And when people come into my office, that's one of the biggest mistakes I see is lack of a proper emergency fund.
All right, so get that emergency fund built up. What next?
From here, typically, after the emergency fund, it becomes a little bit tricky because I tell people there are no hard and fast rules that apply for everybody.
Correct.
Every situation is different and every situation is unique. But is a general guideline, once you have that 1 month emergency fund, then I would recommend starting to invest in your works retirement plan, typically a 401k plan. I usually recommend people contribute to that plan up to the employer match. There's some exceptions, but in general, I recommend contributing to your 401k up to the employer match.
Okay, so what should we know about when we get that job? You're sometimes so happy to get the job that, okay, there's some retirement thrown. How do you know if you've got a good retirement plan or just a so-so one?
Well, in terms of the match is pretty easy. The standard is, and every plan's different, but the standard is most companies will match 50 cents on the dollar up to 6% of your compensation. So to make the numbers easy, let's say somebody's making $50,000 a year. Well, 6% of $50,000 is $3,000. And most employers, if you put $3,000 into your plan, they will put in $1,500. Now, there are matches that are more generous. Some places will match you dollar for dollar up to 6%, which means you put in 3%, or 6% of $50,000, $3,000. Your employer puts in $3,000. So you have $6,000 right away, which if that's the case, if you have a 50 cent on the dollar match, I tell people that's getting an instantaneous 50% return, which there is nothing in the market. You're not going to get that in the market. So
that's a pretty good deal that a lot of people, when
deal.
you're 20-something, you're not worried about retirement thinking, oh, that's such a great deal. But what you just said is pretty impressive.
It is. And now there's exceptions. I've seen some plans where they're a lot worse than a 50 cent on the dollar match. I've seen other plans that are a lot better. When my last year as a doctoral student at Mississippi State, I was a benefits eligible employee. And the plan I had my last year in the doctoral program, the state would match $1.50 for every dollar I put in, up to 8%. So if I put in 8%, the state would put in 12. So that was a total of 20% of my compensation, which my last year for me, that was a no-brainer. I definitely took advantage of that.
All right. So once we start saving for our retirement through our company, what do we do next?
Next, it really depends. And again, going back to the issue of retirement, I said some plans are better than the 50 cent on the dollar match. Some are worse. You know, if there's a plan where they're only matching, say, 10%, 10 cents for every dollar, or if you have a very large debt load that you're carrying, only then do I recommend people put that retirement plan on hold and really attack debt. Because there are some people where, they have so little room to breathe that, one negative financial event could be catastrophic for them. So if that's the case, I usually recommend putting the retirement on the back burner, which is really hard for people to do, especially, when you're getting that 50 cents on the dollar match. But I tell people that, if you're getting that match and then a negative event comes up and you have to liquidate that balance anyway, after penalties, taxes, it's going to wipe out a lot of that positive benefit.
All right, let's talk about paying off high interest debt as another step.
So once you have that 1 month emergency fund, once you're contributing to your works retirement plan, any money left over, I tell people to start attacking high interest debt. Now, what's high interest varies from, one financial market to the next. Right now, rates are incredibly low. So right now, I would say 8-9% I would consider pretty high interest. And next step financially would be attacking that debt. Because I always tell people, if you pay off debt where you're being charged a 9% interest rate, that's a guaranteed risk-free 9% rate of return for the remaining life of that loan, which, again, in financial markets is unheard of.
All right, so you're chugging along and you're just ticking these things off, as Dr. Lach says. I think a big thing is major purchases, and one of them is a house. That is something a lot of us want to have.
Yeah. And I tell people that once you get rid of that high interest debt, typically I tell people the next step is shoot to save 15% of your income for retirement. So, let's say somebody is making $60,000 a year and they're lucky enough to have a dollar for dollar match up to 6%. Well, they put in 6% of their salary, their employer puts in 6%. They're getting 12% put into their 401k plan. So 12% of $60,000 would be $7,200 a year going into that 401k plan. 15% of $60,000, and again, 15% is what I recommend people aim for with their savings. 15% of $60,000 is $9,000. So if $7,200 is going into your 401k and you need to have $9,000, you have about an $1,800 annual shortfall, which just $150 a month going into your IRA gets you to that 15%. The only time I'll tell people to put that 15% plan on hold is if they are thinking about their first house.
All right.
Now, I always tell them, don't get that first house unless you know you're going to stay for at least 5 years or more. in my opinion, one of the biggest financial myths that is floating around in our country is that you're always better off buying a house versus renting an apartment, because the old saying goes, when you're renting a place, you're throwing money out the window in rent, but if you own a place, you're building up equity. But the reality is, when you're just getting started, the amount of equity you're actually building up is minuscule.
And I think back to last season, we had Doug Stanberry on, who's a realtor, and I was shocked when he said, well, Lori, houses are actually money pits, not money makers. Not a lot of people make money unless you're really buying and selling a lot of real estate. So we do kind of get caught up sometimes in this myth of, the American dream of having the house. So if somebody is bound to determine, I want a house, what should they do? What should they look for? How much should they spend?
Well, they should look for, I typically recommend, number one, most banks will tell you that you could have what's called a back-end ratio. A lot of times in financial jargon, you'll just hear it called a debt-to-equity ratio. Back-end ratio are your mortgage payments, your student loan payments, credit card payments, car payments. Lump all those monthly payments together, divide by your gross monthly income, and that's your back-end ratio. Now, most banks, it varies depending on the economy. After the real estate market took a little bit of a dip, banks went back to saying, okay, we want you to have 30% or lower for that back-end ratio. And then real estate started coming back up, and banks went back to their old 38% back-end ratio is acceptable. I think that's incredibly high. Spending 38% of your pre-tax earnings on debt is incredibly high, especially when you factor in what your taxes are going to be, especially when you factor in that 15% saving for retirement. So the rule I typically use for myself, what I recommend to my clients, is aim for a 25% back-end ratio. Now, that seems very low, especially for somebody just getting started, but you don't have to have the home of your dreams right out of the gate.
Really? It seems like when we watch TV, that's what everybody gets, is the granite countertops and the 4+ bathrooms. It doesn't really work that way.
No, it doesn't.
It shouldn't.
No, it doesn't. And the thing people need to be aware of is, the reason for that 5-year cutoff is people don't realize that although you are building equity when you first buy a home, the amount of money that goes towards equity is so small. Just to give you some numbers, if you bought a $120,000 home and you put the minimum amount down, which most banks will let you get away with 5%. So if you put down $6,000 on a $120,000 home, you finance the remainder with a $114,000 mortgage, 30 years fixed rate at say 4%, which are prevailing rates. Your PITI, that's principal, interest, taxes, and insurance. Your insurance national average is about $50 a month for homeowners insurance. Property taxes would be about 1%. 1% of 120,000 would be $1,200 a year or $100 a month. And then you add that to your principal and interest, you're looking at a payment of approximately $677.
Right.
Of your very first payment, only $164 is going towards your principal. Everything else, people think of rent as money going out the window. Well, I think of interest as money out the window. Property taxes is money going out the window. And your homeowner's insurance is money going out the window. And not to mention, I'll give you a personal example, something that happened to me 1 week ago. I own a condo in Louisville, Kentucky, and pilot light wasn't coming on. Brought the furnace people out, and they told me I had a bad heat exchange, which is the death knell for a furnace. So I'm now going to have to buy probably going to be about $3,000 for a new furnace. Whereas if you're a renter, somebody else pays that.
The landlord takes care of that.
Yeah. So I tell people, you want the cheapest house you could tolerate living in.
Yeah.
General rule of thumbs, people will say, get a house that's double your income or 2.5 times your income. If you could go lower than that, I think that's great. My first condo was less than 1 times my annual income.
I remember the first time I bought my first house, and I don't know if this is true anymore. This was before the 2007 real estate crisis. I was so shocked at how much they said they would loan me. I didn't buy a house that was worth that much, but it's easy to get caught up in that.
Yes, and especially when emotions get involved, because you see the house you really, really want, and then you easily fall out of love with that affordable house.
Right.
So probably the best way to avoid getting into that trap is if the home's out of your budget, don't even look at it. Don't get your hopes up.
Don't go there. So what else should we know about major purchases? I mean, house is a major purchase.
Car's a major purchase, and I tell people again, with cars, get the cheapest car that you could tolerate driving until you go through all those initial steps. Once you really have your feet under you financially, you have your financial house in order, so to speak, then anything extra, do whatever you want with it. If you really want that nicer, prettier car, go for it.
Okay.
If you really want to get your mortgage paid off, go for it. If you want to buy a piece of rental real estate, go for it. But only after you've gone through those initial steps that we've discussed. So in terms of a car, I mean, drive your car for as long as it'll run.
All right. So the next on my list is I wrote on here after the house and the major purchases was save more money for retirement.
Yes. So really, once somebody, if they've knocked out that high interest debt, they are, they're taking advantage of the match at work. They've, they're saving 15% for retirement. They are, living in a home if they're going to stay there for at least 5 years. Then I would really start working on getting rid of all the other debt, even low interest debt.
Okay.
A lot of student loan debt is, could be 3, 4, 5%, which I'd consider fairly low interest. Or if somebody has already bought a car before they're watching this episode, then work on paying off that car loan. But ideally, I would like to see somebody debt-free accept the mortgage. And once you get to that place, I really recommend beefing up that emergency fund. I would ideally like to see, for a 2-income household, I would like to see an emergency fund equal to 3 months worth of expenses. Single income household, I'd recommend about 6 months of expenses.
All right. I wanted to talk about, you had a couple of really good analogies or ways to think about saving money. Let's talk about say you go to a fast food restaurant a couple of days a week for lunch versus packing your lunch. What tends to be the normal thinking, and how does Patrick Lach think about that instead?
Most people will think, well, if I pack my lunch and forego that trip to a fast food restaurant, that I'm missing out on a good meal. But I don't look at it as what I'm giving up. I look at what I'm gaining. Whereas, if you go to a fast food restaurant and you spend $9 typically at a fast food restaurant on lunch, and if you pack your lunch, you're only spending, say, $3. Well, when I pack my lunch, I don't sit there and think about the good meal that I'm giving up somewhere else. I'm eating lunch thinking, this is great, I'm gaining an extra $6.
So it's not what you're losing, it's what you're gaining.
Exactly.
And you could take your lunch outside and sit someplace enjoyable and get even something more out of it if it's a nice day.
Exactly. And I think, the same thing with cable television. I don't have cable television, and the reason I don't is I look at every month I go without cable TV, it's $50 a month extra that I'm able to save.
So think about it as what you're saving as opposed to what you're missing out on.
Exactly.
All right. So what else do we need to know?
Well, I think that a lot of people will, they'll want to save for their own kids' college, and I always tell them that you need to take care of yourself first. You don't want to, I see a lot of clients that come into my office where they focus so much on saving for their kids and getting a good life for their kids that they don't think to take care of themselves. And I always use the analogy, when you get onto an airplane and they're going through the worst case gloom and doom, they tell you when those oxygen masks come down, they tell you, put your oxygen mask on first before you put the oxygen mask on for somebody else. And the intention behind that presumably is, if you're dead, you're not going to be of much use to any young ones that are taking care of you. And I think that's a good financial analogy. I call it the oxygen mask rule. Take care of your own retirement before you start focusing on saving up for your kids' college.
Okay. We're going to get into this in a later program. We're going to talk about a little bit, but I want to bring it up now about alternative investments. Say you have ticked through all the things that we should do, and now you have some money to do some things with, and you decide, I want to invest this in some other ways and make myself some more money.
Well, there's a lot of other options out there. There are rental real estate. Some people have always dreamed about owning their own franchise, a prominent fast food franchise. And for those people, I tell them, those aren't bad things. You know, a real estate investment is an investment. Buying a fast food franchise is an investment. But the problem is, and we're going to talk in a later segment, the problem with those types of investments are, in my opinion, they don't have that long established track record that the stock market or the bond market has. So I tell people, you know, when it comes to all these steps, and it seems like there's a lot, especially when you're starting out, maxing out work retirement plan, getting rid of high interest rate debt, then, you know, saving up for a house, then knocking out all your other debt and saving 15%. I mean, there's so many steps, but I tell people, once you've knocked those out, and there are a lot of people that are very, very diligent about going through, and they have knocked all those things out, then and only then do I tell people, you know, now if you really want, if you've always dreamed of owning a piece of rental real estate, start saving for it. Or if you've always dreamed of owning a franchise of your favorite fast food restaurant, start saving up for it. And the analogy I use is, you know, a lot of people probably remember from when they're a kid, or if you're a parent with a kid, you probably do this with your own children, where, you know, parents would often say, no dessert until you clean off your plate. No dessert until you eat all the good food on your plate, and then we'll give you the sugary food for dessert. And I look at things like alternative investments or buying a nice car, things of that nature. I look at that as dessert. And those are things you should only do once you've taken care of the important financial things on your plate.
All right, so Patrick, we have about 3 minutes left. I want to talk about, certainly everybody's life does not follow those steps, and things come along the way. As you said, you have a furnace, there could be illness. You have one child and all of a sudden you're having another one that you hadn't really planned on. Life doesn't always follow these set of steps. So how, if you get derailed, how can you kind of get yourself back on track?
And that's a great point. And that's why I think it's so important to, right out of the gate, you know, a 22-year-old that thinks, well, I'm making $48,000 a year, $4,000 a month, and I have no other responsibilities, I'll go ahead and buy that $35,000 car now because I could afford the monthly payment. The thing is, people don't anticipate that unexpected things in life are going to come along. But I really think in terms of priority, I think number 1 month of savings. Number 2, start maxing out your employer's retirement plan, as long as you have a manageable debt load. And again, that's something that varies on a case-by-case basis. Somebody with a back-end ratio or a debt-to-income ratio of 30%, well, a single person that's 22 with a 30% back-end ratio, they have a lot more wiggle room than somebody who's married with 2 kids and has that kind of ratio. So as a general rule, I think going down the steps in the order that we've discussed them, 1 month emergency fund, max out your employer's retirement plan, knocking out high-interest debt, saving up for a house if you don't have one already, shooting for 15% savings for retirement, getting debt-free except for your mortgage. I think that's a great way to prioritize things. And, you know, if you're contributing up to the match, you've knocked out the high-interest debt, and then an unexpected expense comes up, you could always go back and attack those other steps once you get back on your feet.
Yeah, so you can always kind of, sometimes you do in life, you've got to sort of backtrack a little bit and get yourself back on the tracks and back to where you want to be.
And as we were just discussing that, it made me think of something that, another big mistake that I see students make, and that is, you know, I talk about debt to income ratios or back end ratios of 25%, and I mentioned the bank will let you sometimes get away with, you know, 38, 35%. I always tell students, spend on what you're making right now. Don't spend your pay raises for the next 5 years. So many students will start a job, they're making $48,000, but they look at what they're going to make as they start progressing up the ladder, and they start spending as though they're already making that amount. Live on what you're making now, not what you think you're going to make in the future.
That's a great way to end this program. Patrick, thank you so much for coming by. We always enjoy your sound advice and your great analogies too.
Thanks, Lori.
Thanks. Here's the bottom line for your first financial steps. First, get an airtight budget and keep driving your old car. Next, get a 1 month emergency fund in place. Once you've done that, take full advantage of your company's retirement plan. Next, start paying off high interest rate debts, which is anything higher than 8%. Now here's your crossroad. If you think you're going to stay in the area for more than 5 years, then start saving up for a down payment on a house. You'll also want to continue to save more money for retirement. If you've gotten that far, start working on a 3 to 6 month emergency fund. Now, if you've eaten all of your financial veggies, then you can start thinking about other ways to invest your money. That's for another show. And that's all the time we have for this edition of Money in Your Pocket. Thanks for joining us, and we'll see you soon.
This program is made possible in part by Credit Union One. Proud to support Money in Your Pocket. Credit Union One offers savings and lending options. Additional information on membership available at creditunion1.org. Loans subject to approval. Accounts are insured up to $250,000. By member's choice, this institution is not federally insured.